There's one financial decision that quietly costs returning NRIs the most, and almost nobody gets it right. If you're moving back to India and you have a 401k sitting in the US, here's the uncomfortable truth. Doing nothing is itself a decision. And for a lot of returning NRIs, it's the one that quietly costs them the most. In the next few minutes, I'll walk you through your options. A hidden tax that can take 40% of your account, and the single most important factor that decides how much tax you pay, which is simply when you withdraw. This is education, not financial advice. So let's get into it. Quick reset. Your 401k is a US employer retirement account. You funded with pre tax dollars. Great while you're in the US. The complication starts the moment you become a non resident because your money is still US based, but you now live under Indian tax rules too. Two tax systems, one pot of money. That's the whole challenge in one sentence. So here are your four options. Option 1. Leave it where it is. Your money stays invested and keeps growing tax deferred. Simple, no immediate action. The downside, you're tied to your old employer's plan, often with limited choices. But there's a far bigger risk most people never hear about: US estate tax. As a US citizen, you'd get an enormous estate tax exemption, $15 million. But once you're a non resident who's no longer a citizen or green card holder, that exemption can collapse to just $60,000 on your US assets, and your 401k counts. Anything above that can be taxed at rates approaching 40% if something happens to you while the money is still in the US. On a $1 million account, that's a potential bill of over $300,000. So leave it and forget it is not free. Option 2. Roll it into an IRA. This moves your money into an individual retirement account, usually with more flexibility and lower fees, while staying tax deferred. A cleaner middle path. But remember, an IRA is still a US asset, so that same estate tax risk still applies. Option 3. Cash it all out in one lump sum. This is the most expensive move you can make, and here's exactly why. Say you withdraw $50,000 and you're 44 years old, so under 59 and a half, you'll pay federal income tax, roughly $11,000 in a typical bracket. Then, because you're withdrawing early, you add a 10% penalty, another $5,000, that's $16,000 gone. Your 50,000 just became 34,000. You lost almost a third. And that's before India has even looked at it. But here's the key thing to understand: that one third loss is not the price of having a 401k, it's the price of cashing out early in one lump sum. It's completely avoidable, and avoiding it is what the rest of this video is about. Option 4, and this is where strategy beats panic. Instead of one big lump sum, you plan when and how you withdraw. Because with a 401k, timing isn't a small detail, it's the whole game. Let me show you why. There are three very different scenarios. Scenario 1. You withdraw during your RNOR window. When you first move back, you don't instantly become a full tax resident. Most returning NRIs get a transitional status called resident but not ordinarily resident, RNOR, for 2 to 3 years. And here's the magic. During RNOR, your foreign income, including 401k withdrawals, is not taxable in India at all, as long as you keep those funds offshore and don't bring them into India. The catch: the US still taxes the withdrawal. And if you're under 59 and a half, that 10% penalty still applies. So during RNOR, taxable in the US, penalty if you're early, but zero tax in India. For many people, this window is the single most powerful tax tool they'll ever have. Scenario 2. You withdraw after RNOR ends, but before you turn 59 and a half. Now you're a full resident of India. So India taxes the withdrawal as part of your global income. The US taxes it too, and you still pay that 10% early withdrawal penalty. But here's the relief. Under the India-US tax treaty, India gives you credit for the tax you already paid in the US, so you're not taxed twice on the same money. You pay the penalty, but you avoid double taxation. Scenario 3. You withdraw after 59 and a half. This is the cleanest case. No more early withdrawal penalty because you're past retirement age. India taxes the withdrawal as your global income, the US taxes it too, and once again, the treaty gives you credit for the US tax, taxed in India, credit for the US tax, no double taxation, and no penalty. So before you board that flight, here's what to weigh. Your age, under 59 and a half means a penalty. Your RNOR window, when it opens and when it closes. That's your golden period. Whether your funds stay offshore, remitting money into India during RNOR can cost you the exemption and the paperwork. The right forms are what unlock your treaty benefits and prevent that automatic 30% withholding at the source. I'm not going to tell you which option is right for you because it genuinely depends on your age and your timeline. But this much is clear: doing nothing or cashing out in a panic is almost never the answer. And this is exactly the kind of decision where a cross border tax advisor pays for themselves many times over. So, quick recap: leaving it carries a hidden estate tax risk. Cashing out in one lump sum is the costly trap. But if you plan the timing, the RNOR window, your age, and the treaty credit, you can legally pay far less. The worst move of all is the one made by accident, by doing nothing. This channel is here for every step of your move back: the money, the taxes, and the life decisions that come with coming home. Subscribe and let's figure it out together. And tell me in the comments, what's your single biggest worry about your 401k? I read everyone, and your questions shape the next videos. This was education, not financial advice. See you next week.